We have heard so much about the Volcker Rule, the part of the Dodd-Frank Act named after the former Fed chairman that prohibits banks from making bets with their own capital. It is supposed to make the financial system safer. But what happens if traders do what they've always done? Look for loopholes, gaps in the law that they can exploit? It's a question Robert Wosnitzer, is trying to answer. He's a former Lehman Brothers bond salesman who is now at NYU. He's doing his PhD on proprietary trading. He is here with us this morning. Robert, pardon me for getting the name wrong there. Wosnitzer, I'll get it right. But let me ask you this question. You have been interviewing prop traders, some 30 or 40 to date. I want to know what they've told you about the ban on prop trading in the Dodd-Frank Act.
Sure, and I should also clarify, there's always the distinction between prop traders and traders, and JP Morgan prop trading desk, and then the everyday business of credit trading. And most of the traders I'm talking to are the everyday traders. And it's the distinction between market making and prop trading that seems to be the gray area that nobody quite knows what to do. And basically what traders have been saying is that, well, it's hard to discern when we're acting as agent or acting as principal. When we're making a market, are we taking too much risk? Are we not taking too much risk? And how does one begin to regulate that? So the issue is not even so much about how to get around it, but how do we do what we do on a daily basis and have been doing for the past 20 years.
So if the traders themselves can't define what constitutes prop trading, how on earth do we expect the government to do so? Because in the Dodd-Frank Act, it says, and I know you know this, but we should familiarize the viewers with it, the term proprietary trading means the act of investing as a principal in securities, commodities, derivatives, hedge funds, private equity firms, or such other financial products as the comptroller general may determine. How does he know what to do?
I think he doesn't. I think that was what was so interesting about it is when I first contacted the GAO and asked, well, how are you defining it? Can you talk to me? Who are you talking to define this thing? They said, well, it's too early to even tell. I think it was interesting, too, when even Volcker himself would say something to the effect of, well, every banker I know that I talk to knows what prop trading is, and then nobody seems to know what it is. It's almost like Judge Potter trying to define pornography. I know it when I see it. So what traders are saying is we need to make markets. We need to provide liquidity. That is taking risk. But then the question is, what's the appropriate amount of risk? At what point is it too much? At what point is it too little? How do we start to even begin to understand it? And I think what we're trying to say is there's a longer history to this process, that traders have been taking risk for a variety of different reasons, and there are ways to start to understand it, but I don't know if we can necessarily regulate it entirely.
Does it all come down to controlling the incentives? Because if a trader is encouraged to take more risk because he knows he's going to get paid for it, what's to stop him?
Very little. Very little. And I think
so until we change that part of the system,
I think you're exactly right.
We're not going to get rid of prop trading per se.
I think you're exactly right. And I think that's the issue here, is that prop trading in and of itself isn't brand new, and it's not something that can be isolated apart from compensation, apart from derivatives. For instance, if we were to say, okay, every trader can now own as many securities as they want, but for 2 weeks, we all know we're going to be able to create some sort of an instrument that would offset the time, that would create, some sort of a swap where I could buy these back. All sorts of different mechanisms would come in. So where do you start to even draw the line? So I think it's a real cultural issue more than it is a regulation issue. And this is what the law does, though.
So if you look at the law, do you believe that it's going to work at all, as it's written now, to control prop trading?
Absolutely. Well, I don't know if it's going to work or not work. I think the question right now is really what you're asking is how is this going to be defined, and then who's defining it? And right now, that's a very opaque process. When we talk to the GAO, when we talk to Senator Merkley and Levin, they're trying to get people to talk about this, but it seems that nobody knows who's defining it except a group of lawyers, lobbyists, and perhaps some bankers. And I think all we're trying to say is maybe some more voices need to not only understand what prop trading is, but also start to weigh into what is it we want this financial system to do. Well, I think that's really the question.
Critical questions, in fact, and we wish you luck in your research. Robert
Thanks so much.
Wosnitzer, he is a PhD student at NYU, former Lehman Brothers bond salesman.